and welcome to the Pengana Capital update on the High Conviction Equity Fund. My name's Karen Jones and I work closely with David and Matt from Discover Wealth, and we're really thrilled to be able to present to you an update on the fund that I know that many of you actually invest in as guided by David and Matt. Today I have with me James McDonald, the Chief Investment Officer and Fund Manager of the High Conviction Equities Fund that many of you are familiar with already. And he's joined also by Jeremy Bendich today as well. Jeremy is a recent addition to the team, which is fabulous. Jeremy and James go back a long time. They've known each other from a business perspective for a number of years, and their investment values and philosophy is very much aligned. So Jeremy's a great asset to the team going forward, and you'll hear from Jeremy after I've chatted to James first up. As many of you are aware, it's quite a different approach to investing. James and Jeremy have a very broad asset allocation. The fund can actually move quite quickly, responding to changes in markets. It's a very concentrated fund with a maximum of 20 stocks under normal circumstances. And it also has, as I said, a broad asset allocation opportunity. There are 5 key characteristics that the guys stick to when they're selecting what companies can go into the portfolio. So with that, I'd like James to give you a little quick reminder or update of what those characteristics are that they look for in the companies that they invest in. So I'll just hand over to you, James, to cover that off to start with.
Thanks, Karen. Thanks for that introduction. Yeah, so just to go into a bit more depth on those characteristics that we're looking for. Firstly, we're really looking for companies with very strong competitive positions, and that might be a high market share, a leading technology, a low cost of production, could be a network effect if it's an internet company. So that's an extremely important factor for us. Secondly, and most importantly, we like companies that we invest in to be trading at a significant discount to what we believe the fair value is. And by doing that, we think it gives you downside protection if you're buying the shares cheaply enough, and hopefully it will deliver good long-term upside as well. Where possible, we do like companies to be out of favour, under-researched. It tends to give better long-term returns in our view than trying to follow the crowd. It's not always possible, but it's a nice feature to have. We do like companies that generate strong cash flow generation. If they're not generating a lot of cash, we like them to have very strong balance sheets, a large cash balance that will get them through to break even. And finally, we like quality of management, very high quality management teams who are aligned with our incentives to perform. So that might be share options and a large ownership in the company, for instance.
Excellent. Thanks, James. So I'm just thinking now then, a good example of a stock that you've probably recently introduced to the portfolio that meets those 5 characteristics would be Magnite, and something, quite a new concept out there in the marketplace.
Yeah, exactly. So Magnite's an advertising technology company. It has a pretty substantial market share, 25 to 30% market share in its industry, and very leading technology. It recently acquired another company called SpotX, which really makes it an industry leader from a technology point of view. This company basically sits between the TV companies and the advertisers, and it connects them and takes about a 5 to 10% commission as part of that process. It's an interesting time in the television market because it's one of the few industries that really hasn't fully moved to digital advertising yet. And we think that's going to happen over the next 5 to 10 years. Many of you might have downloaded an app recently, 9Now or 10Play, for example, where you can actually watch TV, catch up TV or real-time TV. And when you signed up to that app, you would have given the TV company permission to serve you advertisements that are relevant, and the TV company will learn about what you're interested in, and that information is very, very valuable to advertisers. So we believe what's going to happen is what's called the linear TV market, the old style of advertising where everyone's watching the same thing, is going to switch over to this connected TV market. In the US at the moment, the linear TV market's about $70 billion market size. Connected TV is about $9 billion at the moment in advertising, and we think that will go to about $50 billion over the next 5 years. So it's going to have a great growth rate. A company recently said its revenue is going to grow at 25% per annum for the foreseeable future, and we think it's attractively valued with about a 3% free cash flow yield in 2022. That is the amount of cash flow it's generating compared to its market cap, and that will grow quite quickly from there on. So an interesting company.
Absolutely. It's certainly the way I sort of watch my TV these days. So I'm clearly contributing to the profits of Magnite there. So thanks, James. And Jeremy, you've got a couple of exciting options that you've brought into the portfolio recently as well. One based on the global consumption of French fries. What can possibly go wrong with that? And also an entertainment company by the name of Hollywood Bowl. Would you like to give us a little bit of background on both of those companies?
Thanks, Karen. And just going back to Jim's comments, the stocks that I'm talking about play into that bucket of a little bit of out of favour. Their stock prices haven't recovered to their pre-COVID levels, but they've got good business models that meet our key criteria. Lamb Weston is the name of the frozen French fry business, and it's got a long track record of delivering excellent returns in a market that is highly consolidated, particularly in the United States, enabling them to earn very high returns on their capital that they deploy in that sector. And they have exposure to restaurants, fast food chains, and we're seeing that strong rebound, particularly in the restaurant businesses globally. That was the reason why the stock has sold off initially. Compounding that has been some recent inflationary pressures for the business, but we think that given the contract structures of the business, those price pressures can be passed on in the next two to 3 quarters, and this has provided the opportunity to buy some of the stock at a price that we think is very attractive, trading at $60 at the moment. It had a pre-COVID price of around $90. So we see that rebounding strongly over the next 6 to 12 months as that thesis plays out, and that puts it on its historic cash flow multiples of around about 4.5%. The other stock that is somewhat similar, it's downstream, I guess, of that industry is a user of French fries chips, but predominantly it's an entertainment company which provides bowling and electronic games and food and beverage to people in the UK. It's called Hollywood Bowl. It has a long track record of building out centres and providing a place where families predominantly can go eat, drink and play during the day, and then at night time where millennials and older people will come to socialise and have a few drinks and engage in that bowling aspect of the business, which is very high margin. There's no marginal cost associated with running a bowling lane. So that company reloaded and has sort of enhanced its growth profile about 6 months ago with a capital raise. It's got a very strong balance sheet. We've spoken to management, very comfortable with how they've run the business. In particular, prior to COVID, they were growing the business quite strongly on a like-for-like basis. So we've recently spoken to their competitor, and their competitor has had an excellent result. We've taken a position based on the fact that we see a strong outlook once again for this business, recovering to maybe £3.20 pound, and that's a nice upside from the $2.40 entrance price that we've made for this stock.
Excellent, thank you. And I think just to finish off our sort of stock stories, James, it's be really relevant. A lot of the clients from Discover Wealth are very familiar with Talix being your largest holding in the portfolio in the healthcare space. So please, could you give us a little bit of an update of where that one's at as well?
Yeah, sure. I mean, maybe for those people who don't know the company, just a very brief introduction. Telix's core technology is molecularly targeted radiation, and that is radioactive particles that are linked to molecules or antibodies which seek out cancer in the body. And at low dose, it can be used for diagnosing cancer as an imaging agent in conjunction with MRI scans, or at high doses, it can be used to treat cancer. The company's really focused on brain cancer, renal cancer, and prostate cancer, all terrible diseases. Prostate cancer impacts about 1.3 million men per year, newly diagnosed cases. So it's a really big problem that we're pleased to be part of trying to treat that problem. Telix has come back over the last few months. They were supposed to get their largest product, Illuccix, approved on the 23rd of September. That has potentially been delayed by the FDA until December, although it could happen at any time between now and December. That product is a prostate cancer diagnostic product, a very large market size of about $900 million US. And we think that product is going to grow very quickly for Telix once it's approved. They have all the marketing in place in the US, the distribution partners, etc. So very important for them to get that, and we're very confident they will get that, but it has been a short-term setback for the company and the share price. The second catalyst that is very interesting and very soon is they expect to complete the enrolment of their phase 3 study in kidney cancer. It's a kidney cancer diagnostic. They have no competition in that market, and it's a market size of $300 to $400 million US a year. So that's also extremely important. The FDA has given that product fast track approval, and what that means is that once Telix has submitted the data, it will review that within 6 months. So we should see that product being approved sometime in 2022 as well, leading to a very strong ramp in revenue later in 2022 and 23. Potentially those two products by say 24 could be doing about $300 million a year in revenue for Telix, which compared to the current market cap of about 1.5 billion Australian dollars is quite substantial. There is one final catalyst, and that's the FDA giving the green light to their prostate cancer prostate cancer therapeutic product. This is a higher risk, higher reward proposal, but that's a $5 billion US market. So that would be utterly transformational if that product's successful. The trial will likely take about 2 years and should commence, as I said, later this year or early next year, depending on when the FDA gives it approval. But we think those three catalysts combined could see a substantial re-rating in the shares.
Excellent. I think that's a really good update in the time that we have. So we've had a couple of stock stories that apply to us all coming out of the pandemic globally and getting out there and doing some really good things. And of course, the company that James has just spoken about, which has a very important focus on cancer treatment and cancer diagnosis. So I think there's some great opportunities going forward. And I think that's what's important to remember about our team at Pengana. They're always out there looking for new opportunities, trying to stay ahead of the trends as well, and being very aware. And they take their fiduciary responsibilities very, very seriously. And I can also obviously say the same that for David and Matt and Discover Well. So I think it's a really good partnership. I guess just to finish up there, it's always important to remember that this particular strategy also has quite a strong ESG overlay, and that's certainly the way a lot of investors are going forward, as well, very, very conscious of what we're doing to the planet and its people. So that's important, and the guys have managed to have that focus as well as get a 32% per annum return since the fund's inception back in 2017. So on behalf of Pengana, I'd really like to thank you for listening to James and Jeremy today, and we look forward to meeting you all personally sooner rather than later.